Did you know that you could be violating HMDA right now and you don't even know it? You see, I discovered a regulatory pothole that you might be tripping in right now that could cost you and your company millions of dollars. No joke here, people, and don't skewer me over this show because I'm serious. If you think I'm wrong, well, just watch, listen, and learn.
On October 10th, the CFPB filed a complaint against a loan originator and servicer alleging that they violated the Home Mortgage Disclosure Act, or HMDA, and its implementing of Regulation C. The 2019 consent order alleged that the mortgage company intentionally submitted mortgage loan data for 2014 through 2017 that misreported certain HMDA data fields such as applicants' race, ethnicity, and/or sex. Anyways, the settlement that accompanied the 2019 consent order required the company to pay a civil money penalty of $1.75 million and improve its compliance management to prevent future violations.
So the CFPB busted this loan officer and this company for $1.75 million for messing up somebody's ethnicity.
Now, despite the settlement and consent order, the CFPB alleges that in 2020, the mortgage company, quote, collected, recorded, and reported inaccurate HMDA data and did not maintain procedures reasonably adapted to avoid errors in its 2020 HMDA data submission. Upon bringing this suit, CFPB Director Rohit Chopra commented, quote, "The CFPB will continue to focus on ending the cycle of misconduct by repeat offenders in the financial industry."
Did you know that the Real Estate Board of New York just passed a rule that could permanently and drastically change the landscape of real estate? It goes something like this.
There's a provision that will prohibit listing brokers from paying buyers' agents and will instead require sellers to pay them directly. The rule also requires listing agreements to clearly outline the seller's offer of compensation to buyers' agents. The new rule is one of 5 revisions coming to the Universal Co-Brokerage Agreement, which governs the Real Estate Board of New York and the Residential Listing Service. The amendments will take effect January 1st.
So in signing a listing agreement, that agreement will be between the listing agent and their commissions only. If the seller wants to offer a commission to a buyer's agent, that will be a separate agreement that's signed. Okay, so what do we fear then?
Every seller will say no, buyer commissions will go the way of the dodo bird, and the already starving real estate industry will suffer more. All of this is in response to the Sitzer Real Estate Buyers Commission lawsuit. Did you know that they just rested yesterday? In short, what's happening in New York is probably coming your way no matter what. But we now know that the lawsuit behind the New York policy changes will more than likely sum up before this November hit, meaning that we'll have clarity as to the future of the buy-side commissions before you eat your Thanksgiving turkey. And finally, this point.
Just understand that buyer-side commissions are going to do what they've always done. They've always done. The market is going to determine if they go up or down. Now, here's the thing. According to the St. Louis Fed, and as you can see here, property values have dropped more in recent weeks than they have since the 1960s, albeit over a very short period of time, but it's been massive and it's been significant. And this, by the way, not so coincidentally, coincides with interest rates going up.
So, in a soft market where properties don't move as quickly, seller-paid buyer-side commissions will increase. So when this hits, you won't really feel a thing. However, as rates drop, and they will, and properties move faster again, seller-paid buyer-side commissions will reduce, as they always have.
Did you know right now, for instance, that auto delinquencies are at a 3-decade high? That is the proverbial canary in the coal mine, isn't it? Especially for our industry. In September, the percentage of auto borrowers who were at least 60 days late on their bills rose to 6.11%, and this is according to a Fitch Ratings report obtained by Fox Business News. That makes this the highest default level in nearly 3 decades and is a notable increase from the previous record, which was only 5.93%, and that was back in January. Vehicle repossessions are also expected to climb in coming months. This is according to Cox Automotive. They estimate that 1.5 million vehicles are going to be seized by the end of 2023, this year, just a couple months from now. And that's up from 1.2 million that we had last year, a significant increase. Check out this graph, and it's available for you right now to download down below. This is the FHFA's graph on mortgage interest rates from 2013 to the present. The dark blue in the far right-hand corner at the bottom are folks with 30-year fixed-rate loans below 3%. It's pretty big. Still over 20% of all mortgages, they'll have a rate below 3%. I can't believe that. The lighter blue above that are people with rates from 3 to 4. And that's about 28%. Or to put it another way, as illustrated with both colored blues, 50% of all mortgages still have a rate below 4%. You're not doing rate and term refinances. Now here's where it gets really interesting. The gray above that, those are folks with rates between 4 and 5%. It's about 20%. So now 70% of all mortgages are folks with rates 5 and below. And then above that, 9% have rates between 5 and 6. And a full 11% of all mortgages right now have interest rates above 6. And those numbers at the top of this graph with a higher interest rate are growing exponentially as we speak. Those with higher rates, the grays and the reds, are going to take market share. And those with the now knowingly artificially low rates are slowly going to disappear.
So Fannie Mae, we all know them. Fannie Mae has projections on the future of the housing inventory, and it's not good. Get this. Housing starts for 2022 were 1.553 million, which was down by 3% from the previous year. Now this year, in 2023, we're at 1.371 million housing starts, down by 11.7% from the previous year. And for next year, 1.241 million starts, and that's down 9.5%, or a combined total of 25% fewer starts than we did last year.
You heard Joanna right. 25% down. Here's a question. Are our housing problems unsolvable then?
As a result, Fannie is projecting new home sales to drop by 0.5% next year, with fewer units being built and sold. The bigger problem is Fannie is projecting existing home sales to drop a whopping 17.8% this year and 0.2% next year. So to Brian's point, new and existing sales are down. Both are dropping massively this and next year. All the while, home builders are building fewer, not more homes. Why?
Here's how expensive our living costs have gotten in this country. Homes are so expensive now that it's affecting how we all collectively date. Oh yeah, have you heard of this?
From Yahoo Finance, a new dating trend has seen men asking for refunds when they don't see a return on investment. How the high cost of living has changed the rules of romance. A new dating trend has been popping up where men send money requests to women after they decline a second date. Some even express they'd like their date's share of the bill back since they didn't get a return on their investment, and a psychotherapist cited by CNBC pointed out that this new trend could be partially due to the skyrocketing cost of living. A first date costs an average of $77 according to LendingTree, and they claim that it's a high price to pay in a time of wage stagnation and inflation.
$77 on average for your first date? Where are you going, Subway? What do you expect to get out of it? With that said, hang in there, guys. It's going to be a bumpy road in front of us. Bye.